The first Bitcoin, BTC, futures-backed exchange-traded fund, ETF, ProShares BITO, is reportedly already in danger of breaching a limit on the number of futures contracts it is allowed to hold under current Chicago Mercantile Exchange, CME, rules. BITO already owns nearly 1,900 Bitcoin futures contracts expiring in October, according to Bloomberg data. To get around the limit, the ETF has reportedly started buying futures contracts expiring in November in addition to the October contracts it holds, with 1,400 November contracts amassed so far. At the current pace, however, the fund could also soon reach CME's cap on holdings for next month contracts of 5,000 contracts, per the report. A major issue faced by ProShares ETF is that futures contracts tend to trade at a higher premium over spot prices the further away their expiry date is, a phenomenon known as contango in the futures market. As such, choosing to get around the maximum limits by buying longer-dated contracts will mean the ETF has to get its Bitcoin exposure at prices that are increasingly higher than spot. This could result in high costs when contracts are rolled over at expiry that will eventually be paid by the ETF's investors in the form of lower returns. According to Bloomberg's own ETF expert, Balchunas, some of the pressure on the first ETF to be launched could be alleviated by competing ETFs coming to the market over the next few days and weeks. However, the first-mover advantage that BITO has gotten will still be difficult to challenge, he said. The unprecedented early volume in BITO makes it like a snowball rolling downhill, as liquidity and assets begets more liquidity and assets, Balchunas said, adding that it will be nearly impossible. Commenting on the possibility of the ETF running into the ceiling, some speculated that the extreme popularity of the futures ETF could eventually pressure the U.S. Securities and Exchange Commission, SEC, to allow a physically backed spot Bitcoin to launch.